To the third session of conference day number 2 here at CBI's Global Annual Conference, focusing on green transitions. This session today is going to be talking about transition imperatives. Of course, energy is always the main focal point when we're talking about transition. It's the most high-profile sector, and what we're going to be looking at today is what is required for a wholesale acceleration of clean power financing and investment. We had an excellent session prior to this one with Lord Turner and Marissa Drew. Lord Turner, who has been driving forward the Energy Transition Commission, and Marissa Drew, a member to that commission, where they have been really looking at what we mean by transition in the energy space. There were a couple of amazing highlights that came out of that, one being the emphasis very much on the need to scale up hydrogen and the role that hydrogen is going to play. Globally, we need to be seeing a 10 times increase in scale. Of course, we need to be pushing towards green, blue hydrogen, and much of this will be dependent on volume procurement that will help drive down the costs of hydrogen going forward. And of course, this will require strong policies in order to achieve that. I'm sure some of our speakers today will touch on that. But of course, also the roles that renewable energy will continue to play. It's been exceptional to see the growth of the renewable energy sector in the last decades. And of course, there's a strong prediction of its expectation to take over coal in the decade ahead. So a very, very exciting session we have before us. My name is Justine Leigh-Bell. I'm the Deputy CEO of CBI, and I will be chairing this session today. I'm quite looking forward to it. We've got an excellent panel of speakers with us today. Before I start, let's go over a few housekeeping things that we need to do. First of all, we'd like to very much thank our sponsors. I think it's really important to highlight the amazing support that they give us. You can see we've got a fantastic group that has come together to support us for today and the next couple of days of our conference. So thank you very much to our sponsors. The WOVA app that all of you that are participants or attendees today, you have access to. The Q&A is there for you to share your questions. And of course, through the session, we will be selecting a number to be able to ask to our panelists today. The Q&A of every session stays live in the app. Also, there is live interpretation in 5 languages. Yes, 5 languages. We've got Russian, Spanish, Portuguese, Mandarin, and Japanese. So hopefully those of you that are in need of that, you can have a chance to use that. The language button is on the Zoom window. Also, videos will be recorded and available in the app from the next day until December. So do make sure that you check out any sessions that you have missed. And I highly recommend that today's sessions that we've had prior to this one are worth a watch. And also, do engage. The WOVA app is there for you to connect to other like-minded individuals in your sectors. So do enjoy throughout the day. We have fantastic speakers with us today. I'll say that starting with Paul Bodnar, who is the Managing Director of Rocky Mountains Institute and the former advisor of climate change to the Obama administration. And we are very fortunate to also have Paul Bodnar as one of our board members to CBI. So fantastic to have you with us, Paul. Grové Steyn, who Managing Director of Meridian Economics, formerly with ESCOM, and will be giving us highlights into South Africa's transition agenda. And he has very much been looking at that closely, and we'll be hearing from him today as well. Of course, Cabra, Executive Managing Director of Technology Development, Resources Sustainability, and member of Repsol's Executive Committee as well, will be sharing with us their experience at Repsol as an oil and gas player in the market on their vision for transitioning. And of course, Mark Lewis, very, very happy to have you with us as well, Global Head of Sustainability Research at BNP Paribas Asset Management, and quite frankly, could be argued to be a world-renowned energy analyst. And so although he will be giving us an investor perspective, his expertise in the energy markets will be very valuable in the discussion today. So thank you for joining us. So now we will turn over to you, Paul. In terms of presentations, each of you have provided a presentation to share with us. Just trying to get those uploaded, if you just give us a minute. Paul, your focus at Rocky Mountain Institute has very much been looking at the energy transition, specifically around coal. And so very much looking forward to hearing you present to us today on some of the areas that you've been looking at. So let me turn that over to you, and hopefully you can see your presentation uploaded.
Thank you, Justine, and may I congratulate you and the CBI team on putting on such an amazing conference under such difficult circumstances, including the simultaneous translation, which I know from my time as a U.S. negotiator in the climate talks is very important and very difficult to execute.
Thank you, Paul.
As you said, I focus on not just transitions at the intersection of finance and industrial transitions, and I wanted to offer a few fire starter remarks before we turn it over to our distinguished other panelists who are doing amazing specific transactions in this space. When we think about finance, climate finance or sustainable finance, for too long, that term has really meant green investment. We've been measuring our success in this space by adding up the number of incremental dollars that are flowing into clean investment or green investment every year. So when we ask ourselves, how are we doing in this space, we most often use the metric of, is there more money flowing into new assets or new bonds indeed in this year than there was the year before. And I want to suggest that we need a much more holistic way of thinking about this if we really are going to dig into the complicated issues of transition finance. So let me offer an analogy on the next slide. I believe you're advancing.
Yep,
you're
got you, yep.
Thank you. So think about a bathtub, okay? Well, actually, let me rewind a moment. If we want to reduce greenhouse gas emissions year after year towards net zero, then what we're really saying is that we want to generate the services of a modern economy like heat and power and mobility, but we don't want the greenhouse gas emissions associated with providing those services. And this, to a large extent, is all about capital stock turnover. It's about changing the assets over that generate the services we want, but to provide those services without the carbon that we don't want, right? Very simple. Now, if we really want to do that, let's think of the economy as a bathtub that's full of dirty water. We want to take a bath, but the bathtub is full of dirty water and we need to replace it with clean water, right? So to accomplish that, it is not enough to simply twist the clean tap, right, which represents green investment, more green investment. Let's get more clean water into this bathtub. No, we need to do three other things. We need to stop pouring dirty water into the bathtub, meaning we need to stop financing the kinds of assets that are not consistent with the goal of decarbonizing the global economy. We need to stop building them, in other words. Secondly, we need to increase the size of the drain in this bathtub so that we can accelerate capital stock turnover. And you'll hear very interesting examples of what's going on in that space, including in South Africa, in coal. So again, we want to make this process happen faster. We want to drain the old stuff out fast as we can and replace it with new clean assets. And finally, we can ask ourselves, how much water do we need in this bathtub in the first place? And that is a question about asset efficiency, right? How many vehicles do we need parked on our streets to generate the mobility services that we need? How much capacity do we really need on an electricity grid to service to provide people don't care about how much electrons they have. They care about hot showers and cold beer. So how much do you really need on the grid to provide those services? So this is just an offer of a framework. We did a short piece on this called Reinventing Climate Finance, which you can look up. Now, let me give you an example on the next slide. So let's take a very simple example, which is we're tracking the transformation of the power sector in a particular country, in this case, the United States. On the next slide, please.
Yes, trying to get there, Paul. Bear with me.
Sure. So we might traditionally be staring at a graph that shows you installed capacity of renewable energy year after year. But what we really need to be tracking is how much new renewable and fossil generation is being put on the grid every year, right? And so this graph shows you on the left a sort of traditional measure, yardstick of success in our field, which is new renewable energy capacity being added to the grid here on the left. And then on the right, you will see in a moment, the same graph, but where if you add two things. One is how much fossil energy is being added to that grid above the line, and below the line, how much is being retired, right? And of what variety of power generation capacity. So if you go to the next slide, please. On the left, you're seeing actual emissions changing during this period. And the turnover of capital stock, which, as you can see, is glacially slow. So although the graph on the first of these two sequences seemed happy and accelerating, in fact, the rate of change is quite slow. And so if you want an honest reckoning of how we are doing on transition finance, I would encourage us all to be using graphs like the one on the right here, which shows all of these things together in a full picture rather than just the happy green investment that you saw in the first of these four boxes. Okay, on to the next slide. So another way of thinking about this using the language that has become common today is climate alignment. So this is really the same thing, but a very general framework, right? We want to increase we want to continue to grow the global economy. So we suppose that the value of assets in the global economy is rising to meet the needs of a growing population with growing energy needs, whether that is from transportation or power generation. But we need to both build the new fleet of low carbon assets to provide that, to fulfill that need. But which is the orange part, and that's the part that many of us are traditionally focused on. But to make a controversial and oversimplified point, you don't reduce greenhouse gas emissions by building windmills. You reduce greenhouse gas emissions by ceasing to operate coal-fired power plants and by making steel out of low-carbon steel instead of traditional high heat, blast furnaces and coking coal. So that it was represented in the white slice here, which is that the act of reducing the high carbon assets in the economy does not happen magically by itself, just by building more clean stuff on the orange slice. So very simple point, but I think perhaps sometimes forgotten in our field. Let me give you just two quick examples, and then I will finish and hand over. One is the case of coal, and this one is now relatively well understood. RMI, the Sierra Club, and Carbon Tracker recently did an asset level analysis of the competitiveness of the global coal fleet. And we found some pretty surprising results. The cost of operating, just continuing to operate existing coal-fired power plants, so forgetting about CapEx, is already higher than replacing those operating costs with capital expenditure for new renewables and storage in 39% of the global coal capacity. In other words, we would be saving money today by phasing out and replacing 39% of the global coal fleet right this moment. We would be saving ordinary customers money, and of course, we would be saving a lot of pollution. As soon as 2025, which is as long as it takes to organize these kinds of transactions, as those of you on this panel know, the picture is already very dramatically different. So the share of uncompetitive coal plants is much higher. It is the dominant majority. And the world would actually be saving cash by replacing the entire global coal fleet net. Now that is a theoretical figure. Of course, it's jurisdiction by jurisdiction. We do offer region by region analysis in this report called How to Retire Early. But the point is that making this transition that I illustrated in the earlier slides is not necessarily financially ruinous. In fact, in a sector which has figured out its technology transition to clean, it actually saves money. And these are big, long life capital assets, and negotiating and engineering their replacement takes time. So if you think 2025 is a long way off, you probably need to think again. If we want to take advantage of these changing economics, we need to start now, and we will be saving customers around the world money, including, believe it or not, customers living in markets with relatively new coal-fired power fleets like China and India. And so again, the only catch is this is not automatically done by the market with a wave of the invisible hand, because 93% of coal plants operate in places where they are insulated from competition from renewables by long-term contracts and non-competitive tariffs. So we've spent the last 10 years in the public policy domain persuading public and private financial institutions not to finance new coal, and that is great. But we need to spend the next 10 years engineering the accelerated transition of these existing assets off the grid, increasingly at a cost savings. And the cost savings is quite valuable because it gives us resources to address a very important aspect of this transition, which is the transition that workers and communities will need to undergo. So having financial resources to do so is helpful indeed. In the interests of time, in the next slide, I will just flash this on the screen and then wrap up. There are other examples of this holistic approach to transition, notably in the shipping sector, where banks representing about $140 billion of senior shipping debt have adopted the Poseidon principles, which pegs their lending decisions against the target for reducing emissions from shipping by 50% by 2050 that was adopted in the International Maritime Organization. And it is the first example of a climate alignment agreement in the financial sector for a major part of the global economy, and it is self-governing by the banks who run it. So I encourage you to take a look at that example. And with that, here are my contact details on the next slide, and I will turn it over to Justine. Thank you.
Thank you, Paul. That was a fantastic kickoff to our session, and greatly appreciate that. And some of the key messages coming out of your opening remarks is very much about the need, or showcasing a strong argument for economic purposes for shutting down coal. Decommissioning existing plants is going to be critical. And of course, this is going to most definitely be saving people money. We need to stop financing assets that do not contribute to a deep decarbonization. So that's a really great way to segue now and turn it over to South Africa, where Grové Steyn, who has been looking deeply into South Africa's market, formerly with Eskom, and will give us a highlight as to what we can expect out of the South African market. Grové, let me turn it to you.
Thank you, Justine. Yeah, can I also just say, from where we sit in South Africa, we're very excited by the theme of your conference this year, and we think it's completely apt, and you'll see now from my short presentation why we think so. Perhaps we should move on to the next slide. And the next one, thanks. So, thank you. So yes, so I mean, in South Africa, we sit with a state-owned national monopoly coal power utility called Eskom, which faces challenges that are probably not unique, and that are probably quite a few other jurisdictions in emerging economies face similar challenges. But our challenges are indeed severe. We face an almost perfect storm hitting our power sector. So in addition to having just recently still almost in the process of completing two very large coal-fired mega projects with enormous cost overruns, we also now face enormous financial challenges in our predominantly coal-based power sector. Eskom generates about 86% of its electricity from coal. We're a very energy-intensive economy. And because of the long time overruns of these big mega projects, we're now in a situation where we actually can't meet demand. So we have regular rolling blackouts. I'm glad I don't have it today, else I might have had some challenges talking to you, but it's almost on a weekly basis now. So in the situation where we are now with, in the kind of post-COVID economic crisis, just as we come out of this COVID crisis and the worst part of the lockdown, we immediately knock our heads against the power shortages in the economy. So we have enormous challenges. Let's move on to the next slide. So South Africa, as you might know, has already started in some tentative ways with transitioning. We have had a renewable IPP program, which is kind of stalled, and we've learned some really important lessons. We've learned that if you have such a hugely coal-intensive system that's been running for almost 100 years, if you start taking incremental transition steps without really having a clear vision on how this transition is going to unfold, that you very quickly run into stakeholder resistance. So of course we have many large economic stakeholders, interests that have developed around our mining, coal mining and power sector industries, and taking small steps towards transitioning to clean power makes it very clear to them that their interests are under threat. And in a situation where the country and our government is not completely clear about how this transition will accelerate and how different stakeholders are going to participate in this new clean future, we have reached a stage where we're almost in a stalemate and the transition has stalled. So we really need transition finance to help us almost create an organizing principle and help lock us into almost like a structural adjustment program in our power sector, which will provide the certainty we need to align different stakeholder interests and create the bridge into this faster transition that we so desperately need. Next, and this is where we think the transition finance can play a very important role. Next slide, please. So we have been working over the last few years on a large transaction that might help us with this challenge. We've been calling it the Just Transition Transaction, or Just Transition Climate Transaction. Essentially what we're aiming to achieve is putting together a large multilateral climate finance transaction framework that will pull in the development finance institutions, climate funds, and crowd in a large amount of private sector green finance into a blended finance structure. We are very ambitious in our aims. We aim to raise at least about $12 billion in total of long-term debt, which will essentially be aimed to refinance Eskom in the next couple of years. But of course, and here's the kicker, conditional on very aggressive commitment to measurable progress on a substantial mitigation pathway. So we're aiming to achieve substantial additional mitigation over and above our current commitments. And the whole framework will impose credible, enforceable remedies into this transaction. So basically there will be three legs as we propose it. The South African government and Eskom will commit to delivering this additional substantial mitigation we're talking about a range of about 1 gigaton of additional mitigation up to 2050. In return for that, we want to put together a highly concessional blended finance package, which needs to deliver real value, which can be measured in terms of financing costs savings in terms of dollars per ton abated. And as Paul has already mentioned, the importance of the third leg, which is we also then need to use some of the proceeds of this finance to support communities, affected communities and labor in the coal mining and coal generation areas and create new economic futures for them. Next slide. This is just really to illustrate the challenge we face and that start to explain the importance of transition finance. So in this scenario, we've modeled the power system aggressively transitioning to clean power. And you can see that on the bottom part of the curve, we imposed a constraint to have all coal off by 2040. This is an aggressive scenario. This scenario will actually deliver about 1.5 gigaton of additional mitigation over and above the current policy plan of the government. But even in this case, we are still going to have to keep coal plant running for the next 20 years. And so the entities that operate this plant, or the entity in this case, Eskom, will of course have to be financed and needs to be financially sustainable while it commits to this accelerated transition. Last slide, please. So we've just developed this diagram, and I'm very pleased to hear we're on the same page as Paul and others talking about this, is that to demonstrate the importance of transition finance. So traditionally, green finance, as we all know, has focused on financing green infrastructure. And that is, of course, a very important objective and will continue to be important in future. But at least when you think about the concessional finance in this context, in countries like South Africa and other emerging economies with very good renewable energy resources, we don't need concessional finance anymore to build renewable energy projects, at least. Given the technological disruption and the cost savings we heard about earlier on today, it is now entirely commercially viable to construct and finance green projects. On the other extreme of the spectrum, of course, we have the divestment movement, which plays a very important role in creating the incentives, or a kind of a stick role, to get large enterprise, or get markets and large enterprises such as Eskom to wake up and start thinking about transitioning. And again, we see this as an important part of the equation. But the challenge now is, once you have countries or utilities that are facing up to this challenge and the need for transitioning, how do we then proceed? Because if we now just divest from them, of course, like in a situation like South Africa, this will create enormous hardship, right? If our utility with its financial challenges and financing challenges now faces further divestment with no alternatives to keep its coal plant running, even while it commits to, or while it executes a rapid transition, we will have a massive financial fallout in our economy. And of course, that in turn will create huge political opposition to accelerating the transition to renewable energy. We're already facing some of those challenges. So what we need to do, in addition to the stick, is we need to provide a carrot, and we need to support entities that are committing to accelerating their transition. We need to support them on the one hand with providing the infrastructure and the decommissioning facilities, etc., that they need to undertake to shut down coal plant, etc. On the one hand, we need to allow that, support them in doing that. And on the other hand, we need to help them to remain financially viable and keep the lights on while we accelerate the transition. So that really is our main message from our experience in South Africa. Thank you.
Thank you, Grové. That was fantastic. Very, very encouraging to see Eskom's ambitions and plans behind their mitigation plans, and specifically it's being very much underpinned by just transition, as you highlight, but also the role that DFIs have to play here. I think you highlighted, and with the approach to blended finance. So we'll talk more about this case specifically. I think it has a lot of synergies to what the US market is grappling with as well, with the public utilities. I think Paul can speak to that. So we'll come back to that discussion. But now let me turn it over to Luis, giving us a case in point example in the oil and gas sector and some of the challenges and opportunities that they've managed to bring at Repsol. Over to you, Luis.
Thank you very much, Justine, and very glad to be here and sharing with you, as you say, our decarbonization plans in an energy company, which is today providing the services that Paul referred before, based on the exploitation of oil and gas resources. We are speaking about transition and transition financing, and I believe that CBI has been doing a fantastic work during the last months in order to define a framework in which credible transitions can be awarded finance in order to fulfill the societal needs, and at the end of the day, being fully decarbonized, hopefully by 2050. So everything is all about credible transitions. And we have seen a very good example with Grové in South Africa, how a credible transition from coal to the new energies will look like. So I would like to share with you how which is our decarbonization path, and you will make your own judgment on whether or not this is a credible transition that complies with the requirements of transition financing. So if we move straight to the next slide, the first I would like to emphasize is that things are taking a huge momentum right now in the oil and gas sector in Europe. And I say in Europe because if you look at the logos of the companies that are now involved in commitments for decarbonization are Europe-based companies, and this is definitely driven by the strong push of Europe and the European Union to the decarbonization. But first reflection is that we need more companies to engage. There are other regions in the world, there are national oil companies, and everything has to move forward. So if we want to be leaders in the energy transition, we need the followers to follow. So just a couple of comments on that. Things started to take momentum back in 2018, just 2 years ago. Total, Repsol, Shell was the first to start. And I would say that December 19 was, at least for us, and I believe that also for the sector, a significant milestone. And modestly speaking, Repsol was the first company to explicitly show the commitment to be net zero emissions in 2050 with a path in between of interim targets. If you look at the right part of your slide, you see that straight after most of the European companies declared different levels of expressions moving towards net zero, starting from companies that are today basically oil and gas. Some of us have already started the transition towards other types of energies. So move to the next slide, Justine, please. And you will see how our decarbonization path looks like, still not with a lot of detail, but the concept is very clear. We have defined a carbon intensity indicator, which is simple, is the emission of tons of CO2 per unit of energy that we put, that we produce. And you see that the reduction path, the graph shows the reduction. So when you reach 100, you are fully decarbonized. And you see that there are a couple of messages there. First, if you look at the orange line, which is our central scenario, is that things will happen progressively. Second, that in 2050, with the technology we can forecast and foresee today, we might be 70% decarbonized, but our commitment is 100. So definitely we need to continue pushing and using the best technology available. We have not incorporated technology disruptions in this figure. And if the best available technology is not able to make the whole work, we will go to the so-called natural climate solutions like reforestation and so on. But from from the very first moment, we have said we need to push to the maximum the capability of the energy system by itself to fully decarbonize. The second message is that you see that there are some lines that open a little bit with time, and this is technology uncertainty and market uncertainty, etc. So we can be very deterministic for what we are going to do in 2025 and also even in 2030. For 2040 and 50, we will have uncertainty and we will need to react to technology development, regulations, etc. But the commitment is there. So this is a picture, but now moving to the next, which I call strategy in action, then you start seeing which are the specific measures we are going to take in the different segment of our legacy business and also in the new business we are already in place. So just a couple of, let's say, highlights. In upstream production of oil and gas, the priority is not going to be production. It's going to be generating cash in order to finance the new business. So when you are generating plenty of cash from upstream at what you can expect to be low oil prices and low gas prices, you by definition are not going to allocate a lot of capital to this part of the business. So production is not going to be an obsession and naturally will decline according to the needs of the society and with the evolution of the competing technologies. Refining and chemicals. Refining is very interesting because an oil refinery today can be in the near future an industrial complex which is doing many things. It's still taking oil and refining, but it's also processing wastes, it's also processing biomass, it's also integrating renewables in order to produce green hydrogen that can be used both for the hydrogenation of the conventional products and also to convey the hydrogen straight to the transport or via the so-called synthetic fuels. We are speaking about future technologies, but we are speaking about today's commitments. We have announced very recently in one of our Spanish refineries a significant investment in order to produce green hydrogen and synthetic fuels that are made of green hydrogen plus captured CO2. So there is one of a limited number of projects like that that are in the world today, just to demonstrate that this technology in a reasonable future can become competitive. This is the legacy part, and now moving to the new low carbon business, we have entered straight into renewables, and we have the commitment for 2025 in order to reach at least a 10% decarbonization of our energy mix. We need to produce 7.5 gigawatts of renewable and low carbon energy already in 2025, which is very soon. And also for 2030, we need to move, and we will move towards, let's say, 12 to 15 gigawatts. So we need this type of investments in order to comply with our decarbonization path, which is, from our point of view, compatible with the needs of the society aligned with the Paris Agreement. All this is tied to, let's say, a new view about the customer. Customer is going to be a multi-energy customer that will get the energy services that Paul was mentioning before, heat, mobility, etc. All these can be part of a package energy services that will be supplied with also new marketing systems and new ways of approaching the client based on digitalization. We are there, we are investing. We will be very happy very soon in November to give a lot of details about this decarbonization path when we will be announcing our new strategic plan for 21 to 25 and beyond. You will have a lot of much more granularity about this transition path, about the investments we're going to make, the profitability we would like to obtain from these investments, such that the shareholders and the financing community can judge on the credibility and can hopefully finance or invest in our company. So that's basically, I have another, I would like to just to give a flash in the last slide, but it's going to be very, because at the end there is a lot of words there, but the point is, if there is a credible path in a company, is not as easy as providing us a green bond for a certain activity. For instance, investing in renewables, we would be happy to get this type of green bonds for our renewable activity. But many times speaking about transition, and Grové said that very well and very clear, also Paul, you need to look at the company and the strategy of the company, because the decarbonization path is not independently investing here or there. Is having a combination, an energy mix, an energy portfolio that goes into the path of full decarbonization by 2050. So very happy to engage in with the financing community and with CBI speaking about these new transition bonds. Thank you very much, Justine. I'm very happy to take questions later on.
Thank you, Luis. That was a very, very encouraging presentation of Repsol's action plan, and definitely we will be teasing it out a bit more as we go along in the discussion today. I guess before I turn it over to Mark, it might just an initial question that didn't necessarily come out too clearly is, what's driving Repsol to take such an ambitious plan? What is it in the market that is actually getting Repsol to move?
Well, okay. Fundamentally speaking, what makes Repsol to move is the conviction that the energy mix need and will change, because climate change is a huge challenge, is one of the biggest problems in the planet, and we need to address that. If we don't do it, others will do it. So we are also conscious that, as Grové said, for coal in South Africa, as of today, the world needs oil and gas, and this will continue happening, probably in a declining way for years to come. So definitely we need companies that do very well the decarbonization of existing legacy energies, and at the same time is, let's say, convinced enough to invest in the new energies. Some of them are still very technologically immature. I didn't mention about carbon capture. We spoke about hydrogen. So all this needs a lot of pre-investment in order to demonstrate that eventually this will become competitive. But the conviction is there, and I believe the world is moving in that direction. So and technology will make it possible. So we are convinced we go in the right path.
Thank you, Luis. Mark, you're an experienced energy analyst. You're now sitting on the investor side. What's your reaction to what you're hearing today, particularly Luis and of course Grové on the South African market with Eskom? Be interesting to hear your views.
Yes, thank you, Justine. Good afternoon, and good afternoon to everybody. Well, I will certainly offer an interpretation of previous panelists' views. But before I do that, I thought I'd just structure a few remarks around three main areas. Because I think one thing that's been missing so far in this, and the trouble is there's just so much to say that however many people you get on and however much expertise, the time is always limited. But one thing I think it's crucially important to understand when we're talking about the imperatives of the energy transition is really to understand what we're talking about when we compare renewable energy with fossil fuels, because there are some very fundamental differences from an economic point of view. Everybody understands the differences environmentally, and that's why we're pushing it as fast as we can. But there's a fundamental economic difference between renewables and fossil fuels, which is not brought out nearly enough, I don't think, in the debates. And I think it's a point worth making, because we now have 15 years of experience, particularly in Europe, with renewable energy, and we can see the economic dynamics of renewables versus fossil fuels very clearly. And I think it gives some lessons around hydrogen. You've mentioned hydrogen yourself, Justine, and the previous session. Luis just mentioned it. But I want to mention that. I then want to talk about, investors already understand that. I mean, the basic point is, and I'll say more about it in a moment, inflation, renewable energy is inherently deflationary by nature, and fossil fuels are inherently inflationary. That's an incredibly important economic insight, because it creates a whole different investment dynamic. If you have a deflationary technology, if the costs are falling, then the way you think about the risk return is very different from how you think about the risk return in an industry with an inflationary dynamic. Investors understand that. This is why renewable energy companies today, particularly the pure plays, are trading on much higher multiples than traditional fossil fuel companies. So I want to talk about that. So I think investors get it. And then what are the implications for policymakers when we understand properly the dynamics of renewables versus fossil fuels? The fact that investors seem to already understand that. If you look at the way the stock market is valuing these different companies, what should policymakers be doing to push on that open door, that the intrinsic nature of these different energy sources give you, and investor responses to that? And I'll talk about carbon pricing and fossil fuel subsidies in that respect. So let me first, if I may, just a few words on the differences between renewables and fossil fuels. You think about the history of fossil fuel industries. I'll focus on oil because it's the easiest one to get your head around. The history of oil is really the history of going up the cost curve. You discover oil in places where it's easy to access. You stick a pencil in the Saudi Arabian desert and the oil comes gushing out. It's very cheap to get out of the ground. Similarly, in Pennsylvania in the 1880s, you stick your pencil in the ground, the oil comes gushing out. That's why we have this word, gusher. You don't find many gushers anymore in the world. We're digging for oil, we're drilling for oil underneath the salt deposits of the ocean off the coast of Brazil. That's very expensive. It takes a lot of expertise and energy. It's high risk. That's the point. There's a high risk. The oil industry has always been primarily an equity finance model because the risks are high. The action is in the upstream. That's where you get the biggest return, typically historically between 15 and 20%. But you get those returns because there's a lot of risk, and investors demand a high return for that risk. And that's why the upstream oil industry is very much an equity financed model. Now, compare that with the history of renewable energy. Already in the last 15 years, even in the last 10 years, we've seen the cost of wind, both onshore and latterly offshore, plummet. The cost of solar energy has fallen by between 80 and 90% across the world in 10 years. The reason that's happening is there is no upstream in the renewable energy industry. You can't emphasize this point enough. There is no upstream. You've just got infrastructure to build. You don't have to look for the energy the way you look for oil and explore for oil. You know where the sun shines, you know where the wind blows. You've just got to build the infrastructure in the right places. The infrastructure is very low risk. And once you build more of it, the cost starts coming down. This is why it's an inherently deflationary business. Now, when that starts to happen and you get a technology improvement as well, investors become much more comfortable with it. So you can put a lot of debt into it, unlike the oil industry, which, as I said, is a very risky business. So it's an equity finance model. So if you can put a lot of debt into it in a world where today, and we can debate the reasons for this, it's the story of another panel, but we are in a world where we have very low, historically low interest rates, negative interest rates for sovereign borrowers, and that makes it seem incredibly cheap to finance new solar and new wind projects, and yet you can still get a good equity return because you don't have to put that much equity in. You can gear up the project. You can finance solar projects in low risk countries with 80, even 90% debt, so that the return you're getting on the equity is still low double digit for a very low risk project with very visible cash flows over 20, 25 years. Compare that with the oil industry, where you don't know what the oil price is going to be next week, never mind in 2030, 2040. So there is a widening gap, I would say, in terms of investor demands for returns in upstream oil, where inevitably over time that is only going to keep going up. The cost of capital for traditional upstream oil activities is only going to increase in the future, whereas the cost of capital in renewable industries is falling for the reasons I've mentioned. It's becoming a less and less risky business, but one where you can still get very decent returns. The second point I was making is you talked about hydrogen. Hydrogen, the production of green hydrogen depends more than anything else, again, on infrastructure. so green hydrogen to produce today is expensive. It's between 5 and 6 euros per kilogram to produce green hydrogen today. The European Commission wants to get that cost down to 2 euros per kilogram by 2030. The good news is, I don't know if we'll be successful in achieving that, but what I do know is the cost base of for green hydrogen is essentially infrastructure-based cost. It's the electrolyzers and it's the renewable energy to power those electrolyzers. We know that the cost of renewables is coming down, so that cost dynamic will continue. If you start scaling up infrastructure investment in electrolyzers, then I think it's a very safe bet that we will follow the same deflationary dynamic as we've seen for the renewable energy infrastructure itself over the last 10 to 15 years. So I think there's a very solid case for saying green hydrogen is going to follow the same pattern as renewable energy and be a very deflationary industry over the next decade. So that's the backdrop of this energy transition, and we've had 10 years observing this, and people now, I think, get it. That's why Luis was just commenting on Repsol's changing strategy. It's why Bernard Looney has announced that BP is going to ramp up its renewable energy spending by 10 times between now and 2030 and look for 50 gigawatts of renewable investments to have in its portfolio by 2030. This is something you wouldn't have even expected to hear from any oil company as recently as 2 years ago. So something has really flipped in the last 18 months. And in my view, what it is the coming together of, the recognition of this virtuous feedback loop between public policy, technology, and investor and consumer preference. And all these four factors are driving and accelerating that feedback loop all the time. Let me talk about investor responses to this. I mentioned earlier, now that it's becoming more widely appreciated what the economic nature of renewables is and what the economic nature of fossil fuels is, deflationary versus inflationary, low risk versus high risk, etc. Investors are starting to value the low risk, high growth energy source, which is renewables, and they're starting to penalize the lower growth, higher risk energy source, which is fossil fuels. So you have companies like Ørsted, the pure play offshore wind company, trading on a PE multiple for next year of between 35 and 40 times, compared with PE multiples for the traditional oil companies more in the 12 to 15 times area. So you're looking at the market essentially valuing the growth and the low risk of renewables at 2.5 to 3 times the rate they value the traditional fossil fuel industries. That is a screaming signal, I would say, to public policymakers that investors get it and they want more of this stuff. So what can policymakers do to facilitate the very strong and very clear appetite on the part of investors for more of these kinds of projects? There are two things they can do, I think. One has to do with pricing and one has to do with facilitation. So when we're talking about pricing, very clearly, there are two sides to this coin. One is to encourage carbon pricing as widely and as deeply as possible throughout the economy. By that, I mean two things. One, that you need to put a price on carbon throughout the economy as widely as possible. So even if you look at the EU ETS, which is the largest and longest established carbon trading scheme in the world, carbon price now finally at levels over the last 18 months, 2 years that reflect where we, at the very least, where we need to be, needs to go higher in my view. So we're about between 25 and 30 euros a ton. The issue though still in Europe is that the carbon price signal, even for the part of the economy that is covered by it, is not being reflected throughout, because you still have free allowances being given to many of the industries. It's being reflected in the power price, but it's not being reflected in the end selling price of the steel, the chemical sector, oil refineries, and so on, because Europe, quite rightly, is concerned about carbon leakage and about the impact that putting a price on carbon in the end selling price would have on European industry when you're not taxing or you're not pricing carbon for foreign imports of those commodities. This is exactly why the European Union is looking at the possibility of a border tax adjustment, and that has to be the right thing to be thinking about. And then we can encourage, you know, what in the economic jargon is called allocative efficiency. You don't get allocative efficiency if the price is not being reflected in the end selling price. So we want more focus on that. But the other thing, the very obvious thing to do is to get rid of subsidies on fossil fuels. This is still out there, massive amount of subsidies globally on fossil fuels, different ways of looking at different numbers that are thrown around. But the International Energy Agency would tell you that the explicit and implicit subsidies on the three major fossil fuels are running at about, depends on the oil price in any given year, but they're running at between $300 and $500 billion a year. But the IMF, if you include all of the externalities associated with fossil fuels, that is to say, the health impact, the public health impact of breathing impure air, you can get up to numbers on, these are the IMF's numbers, not mine, of you know, $5 trillion a year. That's a very big number. You know, that's 5-6% of global GDP. So fossil fuel subsidies need to be eradicated. The point being that doing this is pushing on an open door now. You can't make, and we hear increasingly less, you still hear it, but it's nonsense, but you can't make the argument anymore if you're looking at facts that renewable energy needs subsidies and they're too expensive, so on. Sometimes the only, I would say, the only unfortunate thing about the speed with which renewables have fallen is that it's taken so many people by surprise, and in particular, governments sometimes take longer to catch up with reality, you know, because it's surprised everybody how quickly the prices come down. I'll conclude with one thought, which is another reason why investors are very, very alive to this trend. It's true, and Paul made the point, and Luis made the point, we are going to still be consuming oil and other fossil fuels for a long time to come. But the way that doesn't necessarily mean that the financial future of the oil industry and of the other fossil fuel industries is assured simply because we're still going to be consuming this stuff in 2-3 decades time. On the contrary, what matters for the pricing of a given commodity is not the overall level of demand, but the speed with which the demand for that commodity is growing. And just two very interesting statistics for you to conclude. If you look at total primary energy consumed in the world in 2019 on BP numbers, renewable energy, by which I mean only solar and wind, accounted for only 4% of the total. So there's your answer, right? I mean, it's a tiny part of the overall energy system. How can anybody think that this is going to revolutionize the world? Well, if you look at how much of the growth in energy demand, solar and wind, total energy demand, solar and wind took in 2019, it was 34%. 34% of the increase in global energy demand in 2019 was in the form of wind and solar. If you look only at electricity, it's even more stark. Wind and solar today still only account for about 9% of global electricity demand, but last year they accounted for 86% of global electricity demand growth. That means within 2-3 years, solar and wind will account for 100% of global electricity demand growth. I would say within 5 to 7 years, wind and solar will account for 100% of global energy demand growth. At those points, fossil fuel demand has peaked, but the market is already starting to price that in. We just need governments now to take the further action that is needed. I didn't have time to talk about the facilitation point, but I think it's an obvious point. Where governments can really play an important role is getting rid of bottlenecks, ensuring that renewable energy gets preferential treatment on the grid. Some of the obvious points that have been learned over the course of the last decade in Europe. So I think the economic news is unambiguously positive. It will only continue to improve over time. We need policymakers to step up and really draw the right policy conclusions from what is increasingly obvious from an economic point of view.
Thank you, Mark. That was a very nice insight into what we're seeing in the energy markets, particularly around renewables. It's very encouraging, optimistic view that you give. And it sounds like, you know, it's inevitable that the energy systems will be moving to cleaner sources, particularly on the renewable energy side. Very insightful from my perspective, particularly around the deflation component of your analyses. Right. I think that not a lot of people know that, so that was very valuable. Am I hearing you right that it's the policy barriers that is prohibiting this to moving faster than it's already evolving? What are the barriers?
Yeah, I absolutely think so. And I mean, to go back to Paul's point at the very beginning, the great work that Carbon Track has been doing on solar power in some of these developing country markets versus the incumbency of coal. From an economic point of view, it's a no-brainer. It's cheaper to build new solar and shut down existing coal than it is to continue running the coal. So the blockage there is clearly not an economic blockage, it's a political blockage, because in many of these countries, fossil fuel industry has a very strong vested interest and strong lobbying power. We've seen that in Europe over the last decade as well. For goodness sake, in Germany, they're still looking at offering taxpayer compensation to large utility companies that are closing down coal-fired power stations earlier than they were originally built for. But, you know, that's the whole point of equity risk. I don't see why the taxpayer should be on the hook for bailing those companies out. So I think that's another good example. Even in Europe, people need to understand there is an equity risk now attached to fossil fuels, and you know, policymakers are behind the curve on that, I'm afraid.
Thank you, Mark. I may come back to you to expand a few more on some of the points you made. And also, we're very much looking forward to the release of your paper on green hydrogen. Tomorrow, we will be having a dedicated session to that. So I want to turn it back to Paul and Grové in the sense that, you know, this decommissioning of coal-fired power plants, I know this is a live discussion now in the US market, Paul, particularly on the public utilities, a threatening decommissioning legislation that I'm aware is really putting a bit of panic into the public utilities on exactly how they're going to finance the decommissioning and potentially roll out into renewables. We've had a few commitments coming from New Mexico on this, and it touches on some of the questions that are coming through on how we can use transition bonds to address the move away from coal, and something you can elaborate on, and potentially I'll turn it over to you, Grové, to bring it into the South African context. Sorry, Paul, you're on mute.
Oh, sorry, I thought it was Grové. Certainly, you know, the decommissioning costs are a thorny part of the equation here, and I'd love to hear about how you're addressing this in the South African context prospectively. It's easy to say that it's easy to compare. Well, it used to be easy to compare the capital cost of coal plants to the capital cost of renewables. That ship has sailed. Now it's fortunate that we're comparing the operating costs of coal to the capital cost of renewables and storage. That ship is also getting on the water. But decommissioning costs are indeed a special category, which does vary by jurisdiction depending on the environmental laws in different countries and different parts of countries. So this is a great example of the stickiness of making infrastructure decisions that come back to bite decades after you've made them, right? And the average U.S. coal plant, now we've retired or announced the retirement of over half of the U.S. coal fleet in the last 10 to 12 years. And the remaining plants naturally are quite old, around 40 to 50 years old on average. That compares to an average lifespan of 10 years in a place like China. And of course, in the South African context, we have mega projects like Medupi and Kusile still under construction. So how do you have a conversation about the decommissioning costs of a coal plant that is still under construction? I don't know whether the transition bond structure is particularly well suited to deal with decommissioning costs in particular, as opposed to other solutions that involve the public purse. But I will say in general that, of course, transition bonds are an enormously important part of the solution here that we've been talking about. You know, if incumbents need access to capital to accomplish capital stock transformation, right? They need access to capital markets to build the things we want them to build, to supply the services we need that are different than what they've got already. And if the green bond market was not designed to provide this because it's mainly aimed at green industries, then of course we need a complementary mechanism that allows incumbents that have a more carbon intensive operating base to make this transition. And I'd be happy to talk about the main questions that arise there related to what you're trying to measure in the transition. Is it an asset or activity level? Or is it at the corporate level, or is it at the national, nationally determined contribution level? But they play a very, very important role. And in the United States, we've been experimenting with various structures, including ratepayer-backed securitization, that allow us to accomplish this three-part transition that Grové was referring to.
Yeah, this is, you just nailed it on the last point there, Paul, because there's been a lot of demand to the banks in the US on potential green securitization for the decommissioning. And I think the fundamental question is, well, where do we set those parameters, right? Particularly if we're going to be using a green label when we're transitioning. This is not understood completely. And I think, Grové, just turning it to you, I noticed in one of your last slides, the point at which the divestment to the actual pure green, there's that middle section there that's very much around the transition financing. How is the ESCOM looking at this, and how Meridian, through its consultancy, is looking to define that part?
Yeah, so perhaps I can start with the kind of challenges we face, because we in terms of decommissioning both new and old plant faster than what was initially intended, essentially because we've got stranded assets. We've done studies on our particular power system and particular stations, and the story is actually not that different here to it is in many other parts of the world. Even our new coal stations, particularly Kusile that Paul was referring to, one of the two mega projects, which will have a bit more expensive coal plant. I mean, this station is truly enormous. It's got about, I think, 4,800 megawatts when it's complete, and it's almost completed now. That station is already stranded, and they're still building it. I think what's so there you really and both of Medupi and Kusile, you have this kind of problem where you finance those stations primarily from debt, and a significant portion of that was raised in the markets with a government guarantee, but also DFIs and multilateral development banks play a role. So we know that the World Bank financed Medupi power station in the region of about almost $3 billion US 10 years ago. Mm. So it was at the time the largest, I think, loan that they'd ever done, if I remember correctly. So the one challenge is now we've got all this debt associated with this plant, with these stations, and particularly the new projects. And then, of course, on the side of the older stations, which are generally more expensive to run, they don't really have any asset base left. They, at the end of their lives, on average, actually, ESCOM stations are about 36 years old, and that's with the new mega projects. So actually, the older plants are much older. But there, of course, you face the other challenge that you were talking about earlier on, and that's actually the decommissioning cost itself. And we don't have a lot of experience with that in South Africa, and the environmental requirements are actually quite stringent. So given the utilities' current financial state, they're actually not in a position to finance the proper restoration of those sites. So these are two very different types of challenges. At the moment, what Eskom has done is they've gone to market with a call for proposals on the old stations, on the older stations, saying, we need to repurpose these power stations. We are entering into an energy transition, and they're essentially looking for proposals to either use the infrastructure. They've got a lot of network infrastructure. You need other system services like spinning reserve, etc. So essentially seeing whether the market can respond in a way that could essentially help them to repurpose that infrastructure and avoid incurring some of the decommissioning costs now, but stop burning coal at those stations. And then, of course, the real challenge is the stranded financing, the stranded debt, and that's in our case. The big difference here is it's a state-owned utility. It's not investor-owned like it typically is in the US, for instance. And given that our state itself, the sovereign finances are also not in a good state. Particularly in the post-COVID era, Eskom's debt is now essentially the big portion of it that's really not serviceable. It's barely generating enough free cash flows to service its debt. So we need to get rid of about 200 billion rands. I'm trying to think, that's about 8 billion or 7 billion US dollars of debt on the balance sheets. And the question is, how do you do that? And is it possible to and a significant portion of that debt is also financed by the development finance institutions, so in other words, those exact same institutions who are now adopting quite assertive climate policies. So, they have skin in the game, whether they like it or not. So the question now is it possible to put together a kind of a financing framework where essentially all the key stakeholders come to the party? We as part of the offering from the South African side, we commit to a significantly accelerated transition with highly ambitious renewable energy construction targets, 5,000 or 6,000 megawatts a year, almost indefinitely, on the one hand. But could we then use that as a framework within which we could persuade the sovereign, development finance institutions, climate funds, and even customers through some further price increases to come to the party and put together a package that will get us through this financial challenge, but also deliver the clean sector that we need.
Thanks, Jose. That's quite interesting. I'm going to quickly turn it back to yourself, Paul, to clarify, and then I'm going to turn it over to Luis.
Yeah, thanks. Sorry, I just wanted to clarify, when we can talk about use the word decommissioning in two different ways here. We're talking about retirement or of an asset, right? Which you can stop operating an asset, you can mothball it, you can, and of course you can actually decommission it. The last one, which is of course when you can convert it. I mean, look at the Battersea Power Station in London, now I guess being built or has been built into a fine residential and commercial complex, but was once a coal-fired power plant. Decommissioning can be quite expensive, and it has to do with environmental remediation, right? And all of the things that one has to do with a heavy industrial facility to repurpose it. You can't just take out the boilers and put in apartments, right? Or whatever else you might do with that shell of an industrial facility. In the US, Resources for the Future has estimated that it costs about $100,000 per megawatt to decommission a coal-fired power plant. So for a gigawatt-sized plant, that's $100 million. And that is an additional cost. I mean, it varies tremendously based on the location, but that is an additional cost. And that cost in particular is hard to work into even commercial structures like the ones that I've described. That allow you to have market-based approaches that harvest the savings of replacing coal with renewables. So that is definitely a role for government to help with.
Thanks, Paul. And Mark, I might have you react to some of the points that Paul just made. To you, Luis, Mark had laid out a pretty stark view the cost differences with particularly the upstream costs associated with oil and gas, and the very, very low cost and potentially low risk of renewable rollout. I think some of the questions that have been coming through the audience is, which ties closely to this, is how long should the transition period last, excuse me, how long should the transition period last? How do we ensure that this period is short enough to avoid irreversible climate change and long enough for firms to transition economically? I think that's something that I'd like to hear you kind of with resonating some of the comments that Mark had made, and then I'll turn it over to you, Mark.
Okay, I'm afraid, Justine, that may be the million dollar question, because the pace of the energy transition is something that is very much debatable. That's why we normally tend to take a view which is at least shared enough or is well recognized enough. For the time being, what we are doing is we are taking the views of the International Energy Agency that depicts a number of scenarios well, they have uncertainty, and we have started from the so-called sustainable development scenario, which is still not yet there in the 1.5 degrees C, is something like 1.7 or 1.6 according to the best of the science today. So we are starting from there, and according to this scenario, there are still, I would say, decades of the declining use of oil and from flat to declining use of gas. So the simple answer would be that. If I may have another minute to take some of the comments of Mark that were really interesting. He commented about the different nature of the business and the different cost of capital of the business. So this is something that we are already addressed in a company that today we are oil and gas and then moving to other business segments. And definitely we need to change things. We need to change things in the way we address projects, in the way we organize the company, our business segments, and even our societal structure, in order to be able to capture, on one side, the different typology of shareholders. Some of them, they would like more risk, others would like low risk, and also the different, let's say, low cost of debt associated to the different cost of projects. The second comment on that is that maybe things can change a little bit in the future with regards to risk profile. I still wonder for how long companies that are tied to the price of electricity will be moving around the governments in order the government and the regulation to guarantee that the low risk is low risk, because you leave the price of electricity to move according to, let's say, market forces, the risk will be very significant. But this is something that definitely we need to address, because we are already in the electricity business. With regards to subsidies to fossil fuels, well, this is something that probably we would like to understand better and have better visibility of which are these subsidies that we are not very clear. When we see what the Spanish government has established and has detailed as public subsidies to the fossil fuels, we read things just to make people understand what we call subsidies. Is the reduced tax which is paid by the agro for gas oil, for instance, which is nothing to do with subsidizing fossil fuels, is subsidizing the agro because, well, certain characteristics. So definitely subsidies on fossil fuels is something that we would like to engage in conversations and see whether or not they are. But what I fully agree with Mark is about carbon pricing. So carbon pricing is a must in order to accelerate transition. And regulators can make a lot of work to apply carbon prices which are as global as possible and as ambitious enough in order to mobilize the energy transition. In between, we have already decided to put an internal carbon price in our company. As of today, it's around 30 euros per ton. In 2025, it's going to be 40 euros per ton, and we will continue growing that internally in order to promote internally the investment towards low carbon activities. But definitely regulators should, we would fully support this concept of a global carbon price, or at least as global as possible. So thanks for the time to give this comment.
Yeah, of course. Thank you, Luis. Let me turn it to you, Mark, to get a reaction to that.
Yeah, well, just picking up on the point about carbon pricing that Luis set that up very nicely for me. I mean, one of the very interesting things, I mean, I've been looking at carbon pricing since 2005. I you know, when back in the old days of the startup of the European carbon market. And one of the things that's been most gratifying to observe really over the last 2 or 3 years is, again, how much more widely accepted carbon pricing is in the corporate sector these days. I mean, the best example, really fantastic example in the last 24 hours, the CEO of Volkswagen is now calling for a European-wide CO2 price of 60 euros a ton by 2023 and 100 euros a ton by 2026. Now, the IEA and other bodies, World Bank and so on, the economics of this are well understood. To get to the kind of outcome we want to see with the Paris Agreement, well below 2 degrees, 1.5 degrees, which is becoming now in many circles, many investor circles, the target we should be aiming for. You need at least 100 euros a ton by 2030 to be on track to get that. So I think it's very encouraging that you have the CEO of a major industrial manufacturing company such as Volkswagen calling for this. And of course, the reason they're calling for it is they can see the writing on the wall as well. They're betting the future on electric vehicles now. Again, it would have been utterly inconceivable even 4 years ago that Volkswagen would be betting the farm on electric vehicles in the future. This, by the way, is also another clear flashing red light on the dashboard for the oil and gas industry, because if your major consumer, which in the case of the oil and gas industry, the largest consumer, really, if you put it in these kinds of terms, is the global automobile industry. Road transportation accounts for 55% of global oil demand. So if the world's major car manufacturers are betting on an electric future and asking policymakers to accelerate that, help them get there quicker by putting carbon prices up, then obviously that's a clear signal, as Luis was saying, that for the oil and gas industry. And the oil and gas industry is calling for higher carbon prices, for goodness sake. So why aren't policymakers doing more in that respect? The reason that the car companies, by the way, are betting on an electric vehicle future is twofold. One, because in Europe, at least, the regulations have been very clear, moving in the direction of decarbonisation for some time in terms of reducing your emissions per kilometre travelled, and that's been done via a regulatory mandate rather than by carbon pricing. But we're in a scenario now where if you include transport in a carbon trading scheme, which is under consideration by the European Union, the car companies want it higher so that transition can happen more quickly. I think that's a very interesting signal, and again shows that investors and corporations are ahead of the curve of policymakers on some of the things, and there's too much timidity in policy-making circles. The other reason that the car companies are wanting to accelerate towards electric vehicles is probably, might sound cynical, but it's rational. They're looking at the share price of companies like Tesla and saying, well, if we want to be rated in the same way, we'd better have a bigger share of electric vehicles in our mix, in the same way that BP, Repsol, and other oil and gas companies are looking at the disconnect I mentioned earlier between the stock market ratings of renewable companies on the one hand and the stock market ratings of oil and gas companies on the other, and saying, well, if we want to have a better stock market rating, we actually need to change our business model. So I think it's becoming much better understood what the economics of the transition are all about, and we really need governments to accelerate wherever possible by putting in place the correct price signals. We've talked a lot about carbon pricing, but also to facilitate wherever there are bottlenecks and blockages. And I think if you come back to green hydrogen, the issue there will be making sure that there are sufficient kind of incentives in the early phase of building out the green hydrogen economy. And that will inevitably involve some degree of public subsidy, but you get that back and more in the future in the form of a livable future. Certainly the subsidies for solar energy in Germany in between 2005 2010, if you look back on them now, you think, well, that was an incredibly high and generous subsidy to have given over the cost of carbon, the implicit cost of carbon in the subsidies that was given to solar operators in Germany between 2005 2010 was 200, perhaps even 250 euros a ton. But what it did was to kickstart a solar revolution globally, because the Chinese started targeting the European market, brought the cost of production for solar PV manufacturing down very much more quickly than they otherwise would have done. So there is a global interconnectedness as well in all of this. And I think that is really the key. Recognize that the economics are actually very favorable now. Do whatever you can to accelerate that further from a policymaking point of view, and get rid of subsidies on the old energy sources and facilitate the removal of bottlenecks. I think that's really what we need to be doing.
Thanks, Mark. Those are great, I would say from your perspective, good closing remarks. I think I'll turn to the rest of our speakers. We've got a few minutes left that we need to wrap up. So any final statements before we close off? And maybe keep in mind, there has been a lot of questions around fossil fuel communities that are dependent on the fossil fuel sector. Are we also ensuring that we're bringing them along this journey, given that the transition is fully underway? Grové, can I start with you?
Yes, thank you. I'll be brief, but I'll say that we are indeed learning those lessons in South Africa, and perhaps the broader point around the political economy of legacy fossil fuel systems is that it's all good and well to say governments need to change and respond to the way things have been developing. And there's a certain irony there, because of course it is some governments that, as we just heard from Mark, that actually triggered some of these changes by supporting the early stage technologies. But we are now at a stage where governments, including the German government and also the South African government, are in a sense sometimes a bit slow to really open up the way and push on a half open door to help us accelerate the transition. But it is important to understand why that is. We are going to have to face up to the broader political economy challenges, to the politics, to the fact that there are going to be winners and losers unless we step in and ensure that those communities that are affected by the shutting down the fossil fuel systems are being given a bridge to a new sustainable future. So in South Africa, we definitely, a huge amount of attention being paid to how we can support. Most of our coal mining generation is in one province, in the Mpumalanga province, in the Eastern Highveld. And so there's a lot of attention being paid on how we can crowd in the new green economy, in at least part of it, into those areas, so that as we shut down coal mines and coal stations, we also open up new opportunities. And of course, we will need to finance that. So that will also be an important part of green and climate finance, is to address those particular, what we call just transition needs.
Thanks, Grové. Paul.
Thanks. I guess I would zoom out a little bit and say that we've spoken a lot about governments, and appropriately so. We have a long way to go very quickly in the next decade to get us where we need to be in the decarbonization story. And The climate action project so far has been largely a project of nations, but if we want to decarbonize the global economy, we need to think and act like the global economy, which is not artificially divided into 195 parts, but rather a set of globally connected industries with globally connected supply chains and markets and technology development pathways and companies. And so what I think we're seeing now is we are on the cusp of a pretty major shift where instead of most of society folding its arms and waiting for governments to take care of this problem, there is a far more proactive engagement by industry. And we should all welcome that. And we should make sure that the financial instruments and markets are there to support transition, including transition bonds. But it will require a different mentality, I think, for us as market participants or experts than the one we have had, which is that we are all sort of throwing tomatoes at governments, telling them to do this or that. In fact, one should not expect that the Paris Agreement, that the NDCs of the Paris Agreement will magically add up to an efficient decarbonization strategy for global industries that think in cross-border terms. And if we and if companies like Repsol agree with that, right? If they want to chart their own future rather than waiting for 195 governments to do it for them, then we should be supportive of that move.
Thank you, Paul. Great closing remarks. And so that leaves you, Luis, to wrap us up. Okay, so my last words, I would say that goes to my start is all about the credible transitions. I mean, things will not be easy and simple when speaking about what can be qualified as a credible energy transition. But I believe that the CBI initiative and the document you've been sharing with us during the last days is a very good starting point to define something that looks credible, inclusive, based on best science, and practical to implement. So definitely we will need to look at the strategies of the companies as well as to the qualities and qualification of individual activities of projects. So that would be my last point, and maybe an additional word on ambition and regulation. I would fully support the regulators being ready to put the target, which is 1.5 degrees C, then being ambitious on the acceleration of the path towards 1.5 in 2050, and then trying to be as near as possible to a level playing field. I mean, if the ideal world would be a global pricing of carbon at whatever level would be required to accelerate, that would be perfect. If this cannot be implemented, try to be as open as possible and as neutral as possible with regards to the final solutions. There is a lot of uncertainty still on the pace of technology evolution, etc. So do not try to cherry pick ad hoc solutions that you believe that are the right ones and bet for just one. Be open and establish the ambition and leave businesses and technologies to compete. But thank you very much for the opportunity to share these views with us. Thank you, Luis. It's been a pleasure to have you. And just to say that CBI is also very, very encouraged to see the actions that Repsol has put forward in their strategy, and will continue to look out for those milestones being met. So good luck on that, and congrats on putting the plan in place. I know that's taken a lot of work on Repsol's side, so well done. And to all the rest of the panelists, thank you very much. It was a fantastic session. Very dynamic. I wish we had more time, but unfortunately now we must wrap up. To our listeners, thank you for dialing in. This has been great, and I think that now we will close, and in the next half hour at 3 o'clock sharp, we will be GMT. We will be starting the next session, which will be the wrap up of the day, the market view perspective. Thank you, everyone.